Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, how you going? Thanks for joining us on the podcast today. It's always a pleasure and a privilege, I guess, to navigate this crazy world of property and property investment. And, we have a job here at Smart Property Investment to help Australian investors be better informed. It's a good purpose. It's something we hang our hat on, and we enjoy hosting these conversations with people from right across Australia involved in property investment. And that sort of changes between property investors themselves, whether they've got one property or 50 properties. We love to tell those stories on the podcast. We also have people from within the industry come in and share their knowledge. And that's going to be a big focus of our chat today. So I'm going to do a deep dive into the Sydney market. There's a lot of, I'm going to say, uncertainty about what's happening in Sydney at the moment. We haven't done a deep dive on it for quite some time. To help me out with this is Steve Waters from the Right Property Group. He knows his market pretty well. Steve, how's things, mate?
Excellent. Great to be back again.
It's good to have you here. And, Sydney is a big market. And, before we really get into it, Steve, I just want to touch on this thing around guests onto the podcast. I know people that listen to it, and I know people from within the Right Property Group, they love these investor stories. So
Absolutely.
We want to hear more of them. If that sounds like you, irrespective of whether you've bought a property yet or you've got 50 of them, come in and share your stories. It's the only way that we can help create more informed property investors and build this community. You can contact the team here, editor at smartpropertyinvestment.com.au. We can sort all that out. It's pretty easy. Come on, have a chat. Let us know where you're going and help share that knowledge. And the best thing I've seen around property investors, as you have, Steve, is that those which share, those which care are the ones that do the best, right?
It's a great way to get forward because everyone is sharing information, the good, the bad, and the ugly, just as importantly.
The more you give, the more you get. And property investment, we're all after the same thing, and that is looking to create wealth through property. So let's share the vision. Let's share the journey. Editor at smartpropertyinvestment.com.au. Get in touch with us. We're on social media. Send us a note, direct message, and we'll get back to you. So let's get that sorted out. As we come up to Christmas, I want to be telling a lot of these stories over this summer period. So when you're kicking back and relaxing on a beach somewhere or hanging out or having a glass of wine, whatever you're doing over the holiday period, let's tell some of these stories. Get in touch. But Sydney, Steve, I keep a really close eye on this market. We're obviously recording from Sydney. And some of the criticisms I've had on the Smart Property Investment Show in the past is that sometimes we're a bit Sydney-centric, and I've taken a lot of that on board, and I look to cover the whole of Australia any way that we possibly can. The reality is that Sydney is the biggest city, with Melbourne pretty close behind, and therefore it's going to dominate a lot of the attentions of property investors and therefore our conversations. So that's reality of things.
Absolutely. It always has been.
Always
will
been.
be.
So, but let's get right into Sydney right now. Now, on a Sunday afternoon, I get the 4 papers every Sunday. It's a bit of a habitual habit of mine. I read the Telegraph, which is normally pretty entertaining, then the Sydney Morning Herald, the Fin Review, and the Australian, right? So I pick through all these different papers, and I use it as part of my education so I can be more informed having discussions around property, amongst other things. And everyone's talking about a hot Sydney market right now.
Yeah.
And it depends what your definition of hot is. Now, from what I'm reading from property journalists, and us included, is that there's lots of people in the market that want to buy stuff. There's not many people who are looking to sell stuff.
It's probably the tightest market we've seen in a very, very long time. And what I mean by tight is that just people aren't selling, so therefore agents don't have stock for sale. I went onto one of the suburbs not long ago. I think it was Seven Hills.
Okay, there you go.
And there was a couple of pages there of listings of properties for sale, but 90% of them were already under offer. Now, whether that's a little bit of clickbait advertising for the sales agents or what it may be, just to get the market more stimulated, nonetheless, it's a fact, it's true. And it's the same story we're seeing throughout every corridor of Sydney at the moment, is just how skinny listings are now. But there are certain pockets and certain property types that are still struggling.
So let's use Seven Hills as an example around this, right? So James, our producer, James, mate, do you have a quick look on Seven Hills on smartpropertyinvestment.com.au? Just give us some numbers. When you got that up, let me know. And this is a bit selfish because I just bought a place at Seven Hills, so I know this market quite well. I like the area, but I think there's a lot of areas right across Sydney which has very similar indicators as Seven Hills does. But for those of you that don't know where Seven Hills is, it's really at the junction of the M2, M7, M4, adjacent to Blacktown train line, which is you get a fast train to the city.
Direct line. Not
far from Bella Vista and all the new development that's happening out there in the northwest. Vibrant local economy. It has, look at this, I know Seven Hills quite well. Big industrial area, so there's lots of jobs there.
Yep.
It's also quite a popular place to live.
It's a good area there in terms of blue collar infrastructure, if you will, for jobs, but it's also a quick commute for the white collar back into the CBDs or Parramatta's or Bella Vista, as you say, which is emerging strongly. And it's one of the areas that we really isolated and tried to exploit sort of around that April this year while there was a lot of negativity in the market. And it had contracted in price, but we thought it was a really good tuck away, buy and hold because of everything that was going to happen over the years to come.
So we're getting into dynamics of that. James, what's the numbers on Seven Hills?
So in terms of a house, so we've had a median quarterly growth of negative 2.82%. So it's gone down a bit there. A median 12-month growth of negative 11.65%. So that's also gone down a touch. Median 3-year growth of negative 2.82% and a median 5-year growth of 25.45%.
Okay. What does that tell you, Steve? These are dynamics around markets, right?
Well, it is. It's just that if you were perhaps someone looking at that type of data for the first time, you'd be totally and utterly confused and not knowing whether to continue looking in the area or move on elsewhere. But if you were to move on elsewhere throughout any parts of Sydney, you're going to get that type of data where it's, on the surface, it's quite conflicting. But it's not until you dig a little deeper until you really find out some truth behind it. And so in relation to Seven Hills, I'd probably suggest that there are some streets, some types of houses there that even contracted a little bit more than what that data is actually showing. I'd also suggest that the rebound over the last sort of 3 months has been quite stronger than what the data is showing as well. Because remember, it's just averaging out. And so there are some poor performing properties there and some that have probably outperformed the average.
And this goes into the dynamics of how markets move. And we're talking specifically about Sydney now. Sydney has its own dynamics.
Does.
And, you know, you spoke about it being pretty tight at the moment, not a lot of listings out there. So often if there's not a lot of sales, that can skew data as well. You've got to keep that in mind. But if you look at so Seven Hills, 2147 postcode, so Blacktown 2148, Toongabbie 2146. Seven Hills, actually, and I think about it's quite a big geographic spread. It includes Layla Park, Kings Langley. You got Seven Hills proper, and then Seven Hills you got south of the train line, north of the train line. So you got five distinct areas of Seven Hills where property can fluctuate hundreds and hundreds of thousands of dollars. So not all suburbs are created equal, and sometimes there's huge diversity in suburbs.
And you'll find that the data may start to skew a little bit more as time goes on as the geographical boundaries of each of those little precincts change, or they get suburb regentrification and renaming as new developments move in. So actually knowing the statistical history of the data is very, very important, as well as what you're comparing it to today. But there's similar examples throughout all of Sydney. Southwest Corridor, another good example. Some of the house and land packages that we're just going ahead with this full noise, like just before the contraction that we had, were selling as quick as they could put them on paper as a pre-register your offer.
People lining up out the door, camping overnight to try and get this stuff.
Which was never a good sign. And it's a really good sign of FOMO, and people are just perpetuating the market for whatever the reason may be. But if you fast forward to today, a lot of those areas as well have got some massive oversupply in there. It's got some vacancy rates of nearly double digits in some of these house and land package areas, as well as some of those high-rise apartment complexes that are showing some issues in terms of their construction. So while some markets are really perpetuating along or rebounded with a certain element of buoyancy, there are some that have just gone sideways and potentially contracting a little harder.
Sydney's such a big place, and it stretches from Palm Beach to Bundeena and all the way out west to Windsor, right?
Yep.
You know, it's a huge basin. And there are so many different jurisdictional changes, suburb changes, regional area changes. And I really want to get into that because a lot of people can get confused by it when they're looking at where to invest in this particular market. But I just want to go to a break beforehand. Back in a moment. Welcome back, everyone. Here with Steve Waters. We're having a deep dive into the Sydney market. Now, Steve, how do you start looking at property in Sydney? So we've spoken about this current environment, or this relationship between supply and demand. And we're pretty much on the basis that there's a lot more buyers in the market than there are sellers. The reasons why there's more buyers in the market is that conditions are better for property investors, and that's across a number of different levels. I don't want to dig down too much, but I'd summarise that with around certainty in government. I would explain that certainty in the tax considerations around property investing, negative gearing and CGT. I'd explain that around a growing appetite for lenders to reduce some of the restrictions around securing a mortgage, so serviceability. So it's a better time, and really, really low interest rates. This has created this perfect storm of heaps of people in the market that want to buy property, not too many people want to sell. And the people that don't want to sell don't want to replace property in a market where it's hard to buy as well, right? So this is where we live right now.
That's Sydney.
That's Sydney.
And in Melbourne, to be fair.
And Melbourne, to be fair, and some of the other markets as well. But that's a synopsis of Sydney. But when you look at the Sydney market, where do you begin? Because, geographically, you've got southwest is an area, west is an area, west being from Parramatta all the way through to Penrith, northwest, so we're talking Kellyfield, Baulkham Hills, that sort of growing chunk out there. And I'd probably put Windsor, Richmond into northwest. More west.
Yep.
Then you got Northern Beaches, which is the coast. Then you've got North Shore, which is pretty much a trail line up to Hornsby. Mm-hmm. Then you've got where we are right now, which is sort of North Sydney. What do we call this? North Sydney.
North Sydney proper.
North Sydney proper. So North Shore, I guess we call this. Eastern suburbs, everyone knows about it. Then you've got the Shire, the Shire. And then you've got the probably other area I would say is that, what do you call that area around inner west sort of thing is another sort of big geographic area. So there's all these different.
Where do you start?
How do you work out where you're going to go? It's even,
I think the first thing to premise it by is to say that I don't think the Sydney market is for everybody because there is a cash flow element there which is quite negative compared to other markets around Australia. And so you need to ask yourself, the question is, where is my money going to work hardest for me and what can I afford? Which brings me to the whole affordability rhetoric that we will get into again as the market rebounds within Sydney and Melbourne and some other areas as well. Whereas just like before, as things become more expensive, the rhetoric starts and people look to go to different avenues. Now, whether that be the Central Coast, and some might even include the Central Coast and the South Coast
part of Sydney.
As part of the Sydney Basin.
Yeah.
And I think that's quite fair.
So Wollongong and the Central Coast. So the
Correct.
Wollongong, what do you call that? The Illawarra, I guess. The Illawarra and Central Coast is sort of part of the Sydney environment.
Yeah, because if you compare that to, say, an area like Melbourne, where you went out to Geelong, they classified Geelong as perhaps regional or semi-regional. It's the same time distance, probably shorter from both coasts back into the CBD of Sydney. And so I think people will start to naturally look for better bang for their dollars. But the right here, right now, if you were to purchase in Sydney, I think you need to establish what you can afford. Just forget the purchase price for the minute, but just what you can afford out of your household budget to sustain the mortgage. Because there is some competition out there. Because if you look at it from a different point of view, some renters now, people that rent vesting or whatever it may look like, are choosing now to step up and own their premises or buy premises because the biggest income and the biggest expense being the rent and the mortgage, it's now in some cases and even gaining momentum, it's cheaper to own it than it is to rent it.
Yeah.
Because there's some value around combined with such the low interest rate environment that we have. But the real reason I say I don't think Sydney is for everybody is because of it's not today, but it's tomorrow or next year when rates start to turn around and get back to normality.
So holding property today is a lot easier than holding
It's
property
technically easier today.
in a normal rate environment.
Correct. But then the other argument to that is, well, Sydney construction has stopped. The DA pipeline is bare and empty. And so once this round of construction finishes and yet Sydney's population continues to explode, then these little pockets of oversupply that we have now will reach a point of equilibrium, and then potentially they may tip into an undersupplied market. So what we start to see then is rents run rampant again like they did post-GFC, but not every area, but just some areas. So if there is any rate increase, that might be offset by the increased rents as well. But if you're absolutely banking on the fact that you need rents to go up to be able to support it, I don't think Sydney's your market.
The point you make around growing populations, and Sydney is growing considerable, as is Melbourne, which puts a lot of pressure on supply, which means that there is not enough houses for people who want to live there or currently live here, right? So this is good for property investors.
It's great for property investors.
A lot of the discussion is around whether or not the release of land and developments is appropriate for the growing needs of the population. And there is some talk, and there's a report coming out which pretty much says that it's really the developers who are holding back the supply rather than government regulation of bureaucracy.
I'm not sure about that.
Managing it, So they're saying developers aren't building stuff fast enough because they want to keep the price point high, right? That's what the implication is, but, who knows? And we're talking sort of more outfill stuff, greenfield stuff, rather than, or maybe it's a bit of an infill. Well, there's a bit of infill stuff going on in the way in which Sydney is changing. You just need to look at,
some of the industrial corridors.
Industrial, but you just look at Parramatta, right? The type of developments going up there, Chatswood, St Leonard's, all these areas, Sydenham down in that way. People now, the changing way of living in Australia. So a lot of property still coming online, but not enough to sustain the population, upward supply pressure. So this comes down to, as a property investor, and you look at Sydney, I know I ratted out 10 different unique regions, which all have their own little characteristics and ways of growth. How do you start investing in property if you choose, to your point, that Sydney is the right spot for you? You just get a dart and sort of throw it in a particular area and say, okay, I'll explore that particular ring. We spoke about Seven Hills beforehand, that particular area, which has been driven by the sort of whole Blacktown area. And you read in any sort of paper and they say, Blacktown's a good place to invest, as is Penrith, right? Liverpool, all these areas. Where do you start? How do you start?
Other than what your cash flow can afford, it's what your current situation can afford in terms of the purchase price. Because I think you need to also think about the future a little bit and saying, has the style of investing changed compared to the cycle, the bubble, the great growth spurt that we've had over the last 5 years? Is it going to change the way investors view property? So if we take some of those high-rise areas and how the overseas investors were really fueling that, will we actually see that again in the foreseeable future? Because if we don't see that, and if there's not that appetite for that type of investing, then the developers won't build. And if the developers don't build, then it increases the chance, or it forces a different type of construction type to fuel or to be able to satisfy demand. And so that takes us to obviously scarcity, so the inner suburbs or the stuff that's close on infrastructure, whether it be the CBD or industrial hubs, employment hubs, whatever that may be. Scarcity becomes a real contributing factor, but scarcity doesn't have to be in a city. Scarcity could be western suburbs, the Shire, the North Shore. It's to each their own, to their own unique circumstances. So as an investor looking to invest in Sydney, personally, I would be looking at something for an add value, which builds in some mitigation. And in a perfect world, I'd love to be able to add a secondary income just in case rates go up, which they will, because I want to be optimistically cautious moving forward, and I want options.
So this is talking about cash flow management. So when you're steering your investment decisions in Sydney, you want to be talking about upside potential, so something which is a potential development in the future, some sort of infill. You put a duplex on it, or a block of units, potential for a value add through a granny flat. So these
or even a renovation, just something to build the mitigation in.
So these are tactical, right? These are some of the tactics around it. But let's talk about the mechanism that allow to apply those tactics. So what do you need to look for in a particular area? Is it the same old basis of the fundamentals, infrastructure, jobs growth? You speak to some people that go, that just doesn't matter. It's all just BS, right? But, access to amenities, transport, all this sort of stuff. Are these still really important for Sydney, or they're less important?
I think they're still important, and everybody should know the fundamentals. And if not, there's probably 1,000 podcasts around it. But I think one of the pivotal fundamentals that people overlook is affordability, because that commentary rears its head all the time, and rightly so, because while things are good, things are great, and people tend not to think about that sort of stuff. But affordability is where the masses not just want to reside in terms of being a tenant, but also live. And we want to cater for the masses. Now, if you have the capacity to be able to go up 3 or 4 levels in terms of price brackets and go the eastern suburbs or the North Shore, whatever it may be, then that's not a bad choice either, except the cash flow, the highs and lows were a little bit more fickle. So if you're looking for consistency, that will steer you to some other areas. If you're happy to ride the waves of emotional growth and contraction, then other areas would be your choice.
It's an important point. So you're talking about affordability in that what you can afford as a property investor.
Correct.
So that will dictate where you're investing in Sydney.
Yep.
And I would argue that most property investors, the bulk of property investors, probably aren't dabbling too much in that Mossman, eastern suburbs market. Some are high net worth people, but the majority of property investors can probably operate within that affordable belt in Sydney. Point number one. Point number two, where do most people live or want to live in the future and own their own home, which is good for property investors? And number three, where do most people rent? And what you're talking about is Western Sydney, where I think a fifth of all Australia lives, right?
But it changes, because there used to be, if you take the inner city areas of Leichhardt, Redford, Balmain, that used to be a heavily dominated rental market, but it's gentrified over the decades, just as certain parts of Western Sydney or southwestern Sydney already have. Not that I think you should hang your head on, say, Badgerys Creek Airport, but that's a major infrastructural change physically, but also to the the macro and micro economies of the area. And so you'll start to see better infrastructure there. In fact, I would argue that the more affordable corridors of any state or major metropolitan area throughout Australia have the best infrastructure. They have the best schools, the transport, more hospital choice and the like, because that's where the general population or the biggest part of the population resides.
I think it's an important point. I want to go to a break in a moment, but you spoke about Badgerys Creek, right? You know, people think, yes, the second airport, there's a new aero something precinct out there, heaps of jobs, heaps of this. Yeah. So people think, oh, Badgerys Creek, I better invest in Badgerys Creek, or I need to invest near Badgerys Creek. Like, what's near Badgerys Creek?
Penrith, Campbelltown.
Penrith, Campbelltown. But when I hear Badgerys Creek banded around, which is falling into this greater Western Sydney, people are talking about St Mary's as a key hub for where people are going to be living for this sort of commute into Badgerys Creek. And James, what's St Mary's, James? I'd be interested to see what the numbers are on it. You know, so this is broad reaching. So you don't need to necessarily invest exactly where that piece of infrastructure is happening. It's where people who are going to be leveraging it, using it, working within it, supporting it are going to be based.
It's everything that follows and surrounds it. Well, it encompasses the whole area and everything to do with the project, because it will be ongoing if we talk about Badgerys Creek as an example, even as far down into Wollongong. Potentially as well.
I'm really annoyed. What's that suburb? It's not Picton, because that's sort of near Windsor.
Camden?
No, near Camden, but it's a small little town. Anyway, I need St Mary's, so I've got property there as well, as you know, Steve.
Yes, you do.
Yeah, so I've got St Mary's here for you, Phil. So median quarterly growth, negative 0.45%. Median 12-month growth is negative 10.98%. The 3-year median growth is 1.98%. Median 5-year growth, 33.59%. And the 10-year average annual growth, 8.09%, with a gross rental yield percent of 3.74.
Interesting stats.
See, that just says to me that, you know, it's exactly as I would like. It's rocketed up in value. We bought and we experienced that sort of rocketing up in value, and then it's come off a bit, right? So it's pretty much, that to me says the market's bottom there.
It has. So if we go back to, say, your first property in North St Mary's.
Yes.
Right?
That's
So that
right,
was,
I remember. Yeah.
and what was that purchase price? 220,000,
Yeah,
230,000?
people are like, go and check it out, smartpropertyinvestment.com. Yeah.
Yeah. So, and you look at where that is today, and it's probably contracted a little bit off the peak. Well, it has contracted off the peak. But that area has changed from, and that's now what, 8 years, 7 years?
Yeah, be that long.
So that area has changed significantly from the time that you purchased through to today, as have other areas that you've got your properties in, Campbelltown and the like. So, and it's not because we're following areas that are potentially going to regentrify, for want of a better term. It's because we're made economical sense to purchase at that time, based on the strategy, based on all the other cash flow fundamentals.
I was just thinking about those numbers. They're so it's like the 3 month pretty much is neutral, right? There's like was point something.
1.98, yeah.
1.98, but there's that big chunk of a fall over the last year or so, which was 10+%. So it's just, you could just draw the curve out in my mind, right? You know?
Absolutely.
And these are dynamics you want to be looking for as a property investor in Sydney.
Depends on your risk profile.
Okay.
For me personally, I like consistency and I need to sleep at night. So that's all based around, as we've talked about before, not so much linear growth, because that doesn't happen, but about what the cash flow it derives being overlaid with the growth, because I need the cash flow to support the growth. Therefore the mortgage. Otherwise you've got nothing. So affordable corridors is affordable to me, or it might be to you or someone else.
You know, we're talking about affordable corridors here. We're talking about Seven Hills, St Mary's, this sort of belt at the moment. And that's only a little bit of Sydney, and, you know, I'd like to cover more. But in terms of affordability, you know, I think for Blacktown, for example, the median house price is probably about 700. I'm plucking that number out of the air, but it's about 700 grand, right? And that's expensive. You took $700,000 pretty much anywhere else in Australia outside of Melbourne. That's a pretty fancy place.
It is, but conversely, the amount of clients that we have or people that chat to us that actually think that the Sydney average, or you can't get a property in Sydney for that type of price, or even down to 500,000, 550,000, it blows their mind because they don't think it exists.
And there are places like that. And when we come back from our break, I'm going to pick Steve's brain and get some hotspots from him, because I know he loves a hotspot. Back in a moment. Welcome back, everyone. We're talking Sydney property markets with Steve Waters, and I'm going to get some hotspots from him, but we mentioned a couple of suburbs beforehand. Remember, you can do all this yourself, smartpropertyinvestment.com.au. Just click on the best suburbs, and there is you put the suburb in there or the postcode, and you get all this information. So go and check it out. It's really, really popular. Blacktown, I guessed about 700 as a median. How did I go?
So 665,000 was the median price for a house in
What's the other numbers there on Blacktown?
So Blacktown's had a negative 2.1% median quarterly growth. 12-month has been negative 8.9%. 3 years, negative 0.89%. But over 5 years, it's seen a 31.68% growth. So
Yeah, similar
it's the same kind of thing, yeah.
Similar dynamics.
I think you
as
track that
areas.
throughout a lot of Sydney. And in
I think
fact,
pretty consistent.
Yeah, there'd be areas, I know of areas that have contracted up to 20%, and I know of areas that have made it come off 5%.
We sat in a presentation, I think it was from someone, I can't remember exactly, maybe Tim Lawless at CoreLogic, or maybe it was Tim, and he said that, he was talking specifically around Sydney, and he said the speed or length of time to get to the bottom of the market will be consistent with the speed to get back to the starting point. And it was pretty much a 2-year period from the peak to trough. I guess we hit the bottom of the trough. It's not really going down any further in Sydney, is there? Would you call it? Would you call the bottom? Sydney?
Yeah, I probably, whether I was right or wrong, I called it around election time.
Yeah.
And then when you overlay the interest rate deduction or reductions, that was a given that it was going to
There's
perpetuate
been 2
the
cuts
market.
since the election, right?
Correct. And so I think this time, though, if it was 2 years from top to bottom, or thereabouts, 18 months to 2 years top to bottom, we actually might see that point of the equaling the top of the last cycle potentially quicker.
Yeah.
In some areas, but I stress, I think there will be areas that they need to get back to their averages in terms of growth over a long period of time, generally speaking. And so that might mean that once the hysteria of the reductions and the election and negative gearing policies and the like, once people get used to that, we might start to see that rate of growth contract and go sideways, or just get back to even normal growth rather than what we've experienced over the last 3 months.
We spoke about Leppington. Leppington is southwest. It's sort of west of Liverpool, isn't it? Leppington, is that my geography right?
Yep.
Sort of out towards Badgerys Creek. What were those numbers?
Yeah, so Leppington was almost that mystery suburb, the mystery suburb you had from before. I'm just pulling up the numbers now, so just bear with me for a minute.
All right, the
Where's that
machine
at
is working. Leppington's a relatively new suburb. It used to be semi-rural out there. Now it's
I'd be interested in the
pretty-
numbers because I'll take a punt here. I think they're going to be wildly dynamic.
okay, like all over the joint. All right, what have we got?
Yeah, so a little bit different to the last couple. Median house price in Leppington, 714,000. It's had a negative 8.46 median quarterly growth, as well as a negative 6.05 median 12-month growth. The median 3-year growth has been negative 4.8, but over 5 years it has grown by 19%, with a 4.15% gross rental yield.
And I thought that might have been the case, for the reason being that there are some people out in Leppington with the zoning changes because of Badgerys Creek and the like, have become multiple bazillionaires overnight just with the stroke of a pen.
And these are the sort of market gardens out that way, wasn't
Correct.
it, Leppington?
Yeah, we have a client.
They've been in families for years.
We had a client that had 5-acre market garden out there and have owned it.
Oh, they would have smashed it.
They did. And it was taken by the government. The government needed it for the infrastructure spend and the roads and bits and pieces. And we went back and forth for a long time negotiating the price on what they should sell it for. And they got very handsomely rewarded. But they've also been there for a gazillion years. And there are other, perhaps, people that controlled quite a lot of acreage around there, being market gardeners or dairies or the like, that have actually done very, very well out of it. It's not like a suburbia with tens and tens of thousands of houses where you can actually measure accurately the data metrics and make a conclusion based on that.
We're talking medians here because, and people need to remember we're talking property data in that. Median is, if you've got 100 properties, it's what the middle of that, so the 50th property sells out, right? Correct. That's a median, it's not an average.
No.
So it can be skewed in a lot of ways, right? You could have a lot of off-the-plan one-bedroom apartments in a tower block, which can really skew numbers, and you might have what we're talking about is market gardens with a high price point. And my recommendation to anyone, if you are from Sydney, and even if you're not from Sydney, get in a car one Saturday and go take a drive, because, from the eastern suburbs out through to Parramatta, that's probably what you expect Sydney to look like. But as soon as you get outside of that belt, which is bordered by probably the M7 going south, M7, M2 going south, there is still a lot of big acreage out there and market gardens. Like, it's still in many ways a bit of a rice bowl, of creating the fruit and vegetable that we eat here.
I think that's a really good point, because Sydney is one of those only cities that is geographically bound. So if you take Melbourne, they can just spread and spread and spread. Like if you take Geelong and Melbourne, once again, to the outskirts of Melbourne through to Geelong, there's a lot of open fields, green paddocks, literally. Yeah. Brisbane, pretty much the same thing. South Australia, of course. Perth, of course, and the like. So if you come back to Sydney, we've got mountain, sea and national parks that really strangle us, in terms of...
There's a lot of water through there as well.
Correct. There's a lot of flood zones that run through there. So that then automatically denies construction for the future as well. So land content in Sydney is scarce, and it's getting more and more and more, especially as our population.
So houses or
expands.
units in Sydney for you?
Oh, top line houses, always. There are some times that we buy units. Right now is not one of those times.
Yep.
Because there's such an oversupply, and that will turn around, but there's also a construction scenario that we all know about. But if you wanted a hot spot.
Give me some hot spots. That's what our listeners want. They're going, this all sounds good, guys.
What about a hot spot?
Give me some hot spots. So we've spoken about, I think we both agree that belt around Western Sydney. So I border that. And I think you should be having a look at this as a property investor. St Mary's, Blacktown, Seven Hills, Toongabbie, Winston Hills, that sort of belt. I really like it at the moment.
But not any house
anywhere,
in any
in
street.
No. You got to look for these, like a place like Seven Hills, which has sort of 7 unique parts of it.
Correct.
You know, like Layla Park, which is a lot of 2147, same postcode.
Yeah, Winston Hills, yeah.
Winston Hills, but Layla Park, originally a lot of housing commission out
Correct.
there on big blocks.
Yep.
You know, some great buyers out there. So give us some other places to look at.
Okay, budget's not a concern.
Budget's not a concern.
All right.
Give us some.
I'll give you 3 or 4 options. First one is if budget's not a concern and you have all the money in the world
what are
to
we
spend,
basing this on for capital growth?
Capital growth.
Long-term capital growth.
Yep. I would take as big a land content that you could get anywhere in the Sydney Basin.
Okay. So you're just saying big land.
Big land. So
What's big land? Over
acreage.
Acreage. So you're talking land banking.
Because we are literally confined, as we talked about. And so over the generations, even if it's generational wealth, you will do well out of it.
And this is what we're talking about, these belt where you still have a lot of market gardens.
Correct.
You know, there's a lot of acreage up in Dural, but that's big bananas, right? You got to go a bit further to capitalise
But even
on
if you
that.
get Dural, that will eventually
You do it right.
From the time that I knew it through to today, it's changed immensely.
You drive this road every day, the Windsor Road. There's still a lot of acreage out there.
Yeah, but a lot of it goes underwater or it's power line affected. So if budget wasn't a problem, acreage where you can with no flood, no power line easements or
So
anything.
what suburbs would they be? He's going to be cagey. He's not going to give us.
No, I don't
anything
mind.
about
I
it.
just don't think there's any secrets. If you dig hard enough, everything is out there.
Yeah.
Certain parts of the Hawkesbury,
Okay.
certain parts.
Like Richmond? Too far out.
No, I like Richmond. There's just a little bit of road works and bridge works they've got to do there to handle the
It's
traffic.
a huge floodplain heading in there.
Yeah.
Right?
So once again, it's isolated in terms of what
Pitt
else
Town.
can done. It's already gone.
Pitt Town's gone.
Yeah, Pitt
Great
Town.
pub out there.
It is the pity. And it floods around that. So once again, you've got to be careful. So the Hawkesbury region through to the southwest corridor, all the way down to in and around Camden and the like.
So banking around there, you reckon?
Yep.
Around that sort of Baker
because
Creek
there's
area.
not much actually else where you can land bank like that.
True.
So if really there's only 2 or 3 bastions of acreage left that's got potential in the future, that's it.
What's Camden doing, James? Can you look at that for me?
Yeah, so just pulled Camden up here. Camden is an interesting one. A lot of stuff in the green here. So 683,750 is the average median house price. Median quarterly growth 0.37%. Median 12-month growth is negative 4.1%. Over 3 years, the median growth is 9.84%. And over 5 years, it's seen a 41.86% growth with a 3.5 gross rental yield percent.
Have you got average annual growth over 10 years there?
10 years average annual growth, 7.34%.
So now there's a reason behind that. Now this is where data, you need to know the truth behind it because a lot of those acreages or some of those larger blocks got subdivided into smaller blocks just in the last, say, 5 years. So instantly they will start affecting the data and everything around it. You'd probably find that there's a population change there as well because more families are now living in there as compared to what they were 10 years ago. But nonetheless, when you throw it all into the wash and it was 7% over 10 years, considering the wild swings and roundabouts we've had.
It's not bad.
It's not bad. And so if you came, next hotspot, if you came down into let's say the northern parts of Sydney, I like anywhere from, let's call it North Sydney, so where we are today, because it's limited and its ability to be able to jump on pieces of infrastructure and move wherever you need to is a lot better than some of the other areas throughout Sydney. Okay. That takes me through down to also your Mossmans, Neutral Bays and things like that. But if you're really looking about nuts and bolts stuff, the Hills District, I think, will have a resurgence.
Borkham Hill's supposed to be bounced back. But Borkham Hills during that last sort of spike was a huge performer. It's probably come back a lot, though, I
Massive
reckon.
amounts.
If you look at Borkham Hills. And
just pulling it
so
out.
Borkham Hills, talk about diversity. So Borkham Hills, if my geography is right, borders up to Windsor Road, and adjacent to Borkham Hills will be Kings Langley. Kings Langley is 2147 postcode, which is 7 Hills. So, you've got Borkham Hills and pretty much 2147 and Borkham Hills postcode, which I can't remember what it is, are side by side. Two hugely different markets. Borkham Hills is the hills.
And you know what will happen?
2147 Hills is Western Sydney.
Which is why I like, your Kings, Langsea, Seven Hills and all that sort of business, is because people will start, as time goes on and affordability becomes a talking point again, people will do what we call postcode hop.
Yeah.
Meaning that they'll say they live in a particular area with the same postcode or close enough to it because they want that aura or stigma attached to
So
themselves.
Windsor Road, essentially. So Windsor Road, for those of you not familiar with geography, pretty much goes from the M2 straight out to Windsor, right? So, and that pretty much is the dividing line between western suburbs and the hills.
Correct.
Isn't it? So
and a bit of Richmond Road. Yep.
Yeah, Borkham Hills is the hills.
Yep.
That is right next door to 2147, which is Western Sydney.
And the other big reason for it is there's a lot of really good schooling in and around that area, and because it's a great catchment zone for some of the specialist schools, and everybody who can wants to be in part of that. And so it's a lot of the reason we saw Borkham Hills and perhaps some of the zoning changes really amplified its growth. But then I bet the contraction was pretty steady as well.
Yeah, so I got some numbers here for Borkham Hills. Median house price is up at above $1 million, so 1,050,000 is the median house price.
And sorry, just on that, and what was Seven Hills? Or was Blacktown? High sixes.
670.
Okay, huge difference.
Yeah, so median quarterly growth, we'll call it negative 1%. Median 12-month growth, negative 10.33%. Median 3-year growth, negative 0.94. Median 5-year growth, 28.05. But the 10-year average annual growth, 7.67, with a 2.92% gross rental yield.
So it's going to cost you a bit, the whole property out
I was about to say, if you're really tight on skinny on cash flow, that's not your
Probably
place
not the spot.
to be. But look, you can get, the average was over $1 million. You can get it cheaper than that. And that also runs over into Castle Hill, which is probably another step up as well, because there's a lot of infrastructure in and around there, the metro.
Well, a new
Vista.
tunnel now linking you in with M2 and is it the M1 that goes north? M1?
Yep.
F1.
The old F3, I think it is. Yep.
Yeah.
And so I think that's, if you can afford it, that's a really, really good area.
Yeah.
But if you want to spread your wings other than the western corridors, the North Shore we just spoke about, or the Hills District, I like the Central Coast.
Okay.
And the South Coast, so Wollongong, because there's a major bit of infrastructure that's happening at the end of the F1, the old M1, the F3, which is, for those that know it, the freeway from the Central Coast or Newcastle to the Central Coast into Sydney stops at Pennant Hills Road.
Yep.
And it can literally take you an hour to go 100 metres. Sometimes it's just next level traffic
There's a
jam
tunnel going
every
in
day.
there and a link up there.
Halfway through construction is the tunnel at the end of the freeway that'll take you onto the M2.
Yeah.
And that is a major, major psychological
So it's going to open up the Central Coast. So the Central Coast become a lot more livable because speed to work, or if you
potentially,
do commute.
yeah, because it's a psychological thing as well. There's already the rail, as we know, back into Sydney from the Central Coast. Yeah. So I think that southern part of the Central Coast will do well because it also offers affordability, lifestyle, because it's quite coastal, the Central Coast clearly. And also the other area is Cherrybrook. I like that because Pennant Hills Road, and it will now not become an issue with the tunnel under it.
True. Big bananas though. I reckon buying in Cherrybrook's got to be north of $1 million. I reckon it's going to be 1.2.
Yeah.
Get the numbers up for you now, Phil.
CHERRY. Yeah, I reckon Cherrybrook's got to be 1.1 something.
Yeah, give or take either side of $1 million. So whilst I'm being pretty general, we don't know what the audience, what their capacity is, but I just think there is certain pockets within Sydney that really will have the ability to take advantage of, but I think there's only a window of opportunity.
So according to the numbers here, Cherrybrook's had a pretty good couple of years. The median house price, pretty close to what you said, up at $1,391,000. So a decent price in Cherrybrook. Median quarterly growth, 0.43%. Median 12-month growth is negative 7.27%. Over 3 years, it's seen a median growth of 1.53%, and over 5 years, 41.94%.
Absolute growth.
Yeah.
And
so
what's
10
the
years
10-year average?
10 years average annual, 8.13%, and a gross rental yield of 2.84%.
I remember buying there for $600,000.
Yeah. Those numbers are good.
They are good.
It didn't drop as much as other suburbs, and it's sort of bouncing back quicker.
Selective schools, once again, access to some of the infrastructure sort of routes. And it is quite, once again, there's not tens of thousands of houses in this. It's quite a small suburb.
Yeah. Again, the rental yield's not great, so it's going to cost you a few bucks to hold there.
But that goes back to what I was saying earlier on in the conversation, is that I don't think Sydney is for everybody.
But the thing is that would you go, okay, that's pretty much done. It's performed so well. There's not much left in Cherrybrook. Well, we're talking about saying, well, this should really continue. It's tough.
Well, it depends on where you draw the line. If I go back to My very first investment property, 105,000 in the western suburbs. And it, when it doubled, I thought, surely it can't do it again. And it did. And well, that's got to be it, but it did it again.
So conscious of time, we've spoken about west, northwest, the hills, and then up through Cherrybrook, which is moving on to the North Shore, around the North Shore being this particular area, North Sydney, Neutral Bay, a lot of unit market. What about sort of down south, southwest? Sort of touched on Leppington and Camden, but how's Campbelltown getting on?
Good.
Do you like Campbelltown?
I do. We've done, I like to think, extremely well since, let's call it May, June, through to now, where we've just skirted around the edges and picked up really good, what we believe to be undervalued properties, together with, we've even been lucky to pick up some house and secondary incomes down there as well, which in Sydney gave us I think it was like a 5.5%, 6% yield straight off the bat.
Yields. And Campbelltown, like Blacktown, so Seven Hills, Layla Park, Marryong, St Mary's in some ways are sort of satellites of Blacktown. Campbelltown's a big place as well. You've got places like Ambervale and Ingleburn and Aids and so it's a very diversified market as well. You've got some very expensive property out at Campbelltown.
Multi-million-dollar properties.
What's that? Up in the hills, there's a really nice suburb.
I don't buy that.
Campbelltown's quite. Have you got any numbers on Campbelltown?
Yeah, I've got Campbelltown right here. So median house price, 554,000. So it's seen a median quarterly growth of negative 2.81%. 12-month median growth, negative 12.76%. Over 3 years, it's negative 3.65%. And over 5 years, 36.79%. 10 years average annual growth of 7.51%. And a gross rental yield of 3.78%.
Just while you're at, can you look at Ambervale for me? Got a place there.
So if we look at that, right, so you mentioned Ambervale and we just looked at the data on Campbelltown. That's only pulling up the data for Campbelltown, not the region.
The whole region.
So you need, when people do measure their data, they need to be very, very specific.
Yeah. So if you look at Ambervale and also look up, Ambervale is south of Campbelltown, whereas Ingleburn's sort of a bit north, but it's all part of the same precinct. So we've got a bit of balance. Yeah, but Sydney is a big place, right? It is a conglomerate of satellite cities, and this is the changing evolution of Australia. We have essentially 2 CBDs now.
Yeah.
We have Parramatta and we have Sydney, but then you've got these micro CBDs. You've got Penrith, Liverpool, Campbelltown, Blacktown, Hornsby. That's about it. What would sort of be sort of south CBD? Penrith,
Chatswood as well, don't you?
Chatswood, a mini CBD. So these are their own individual ecosystems, which if you put all of those cities in the sort of the spectrum of Australia are some of the biggest cities there are.
Yeah, whether it be via a population point or even an economic point of those little micro ecosystems measured against other parts of Australia, it's got great pulling power. And I think, we need to understand the human psyche behind where people want to live. Because not everybody can afford or will ever be able to afford Sydney Harbour waterfront. But that the law of averages will tell you that the majority of people will be able to afford these corridors.
Yeah, and this goes back to affordability. So how you shape your investment decisions. Any numbers, James?
So Ambervale.
Yeah.
Yes. Got Ambervale median house price, 530,000.
So more than Campbelltown. I was about to say.
A touch more, yeah. Quarterly growth, negative 0.47%. 12-month growth is negative 9.4%. Over 3 years, it's seen a 1.53% increase. And over 5 years, 41.71%. With a 10-year average annual growth of exactly 7% and a gross rental yield of 3.92%.
So yield's a bit better.
And so all of those figures that we've talked about from Seven Hills to Campbelltown to Chatswood or wherever else we just measured just shows you that even though there's peaks and troughs within a cycle, the longer that you can be in the market, the better you're going to do.
Yeah. I think everything's done 5 years, more than 35, 40%.
Yeah, all the data's been positive on 5 years. But
so if you're the type of investor that's trying to time a market, specifically the bottom and the top where to get in or get out of the market, you have to be right more times than you're wrong. Otherwise, the consequences financially are huge.
Trading property is a tough one, right? It's time in the market rather than time in the market. And this comes back to cash flow, which we speak about all the time.
All right, so Ingleburn. A little bit above the last couple. So 638,500 is the median price on a house there. Quarterly growth, negative 1.77%. 12-month has been negative 7.46%. Over 3 years, it's seen a 2.57% increase. And over 5 years, 38.8%, with a 10-year average annual growth of 7.47% and a gross rental yield of 3.5%. So those 10-year averages are very similar.
So that's a suburb of Campbelltown as is.
Correct.
Ambervale, and Taylor 2 very, very different suburbs. You know, Ingleburn's a bit newer than Ambervale. I think they sort of got built probably early 80s.
Yeah,
is when
and
it sort of
there's
come up.
certain parts of Ingleburn there that has some, potentially some pretty high net worth positions there as well. Whilst that average looks very good, there's some very expensive parts of Ingleburn as well.
So we've gone around and around Sydney and, rattle out some numbers there, James, and, it's painted a pretty good picture if you've been in the Sydney market for quite some time. If you got in Sydney 5 years ago, you probably did pretty well. And that shouldn't be the paradigm for how property's going to move forward.
No.
And that's what people get mixed up. They go, well, Brisbane's going to do the same, and it hasn't.
And every market is quite different. Melbourne may not have the same figures as that, or even perform going forward as well, or might perform better. South Australia, Brisbane, Northern Territory, Perth. Every one of these markets clearly has a subset market within it.
Yeah.
And finding the pinch point where supply is going to be outstripped by demand on a consistent basis over a period of time is really, really important. And then also making sure that you're not measuring or modelling linear growth, as we've talked about before.
Yeah. What goes to show growth isn't linear. It's
absolutely
it's peaks and troughs, right? Like it's gone down, but it'll come back up again. So I'll finalise this podcast and a bit different than how we normally do it. So if you like what we're doing with this, let us know, editor at smartpropertyinvestment.com.au. We can get this micro if that's what you want us to do. Everyone else seems to be doing it, but is it a good time to be investing in Sydney, Steve?
I think for some people, yes.
Okay.
I think, as I said before, it's not a market for everybody.
So you need to understand and appreciate that investing in Sydney is going to cost you a few bucks. There's not going to be a lot of positively geared stuff unless you're going in with a really low LVR. If you're
Correct.
borrowing at 80%, you're probably going to be negative initially.
You will be. And if you're skinny on capital and skinny on cash flow, you won't be able to get into the Sydney market.
But if you have that capability now, you're probably going to see some pretty good long-term growth in Sydney.
Yeah.
Yep. Okay. I concur. Thanks for coming in, mate. I enjoy the chat.
Always.
I like talking about Sydney. It's a great place to live.
It is. There's so many other markets. We could speak hours about Melbourne and Brisbane.
Well,
and
we'll
South
do. So
Australia.
let's do that. What market do you want us to do next? I'm sure Steve will be happy to come and have a chat about it. So you guys choose. We're happy to cover any market in Australia. I'm not too au fait on Alice Springs or
We'll do it.
any of
We'll
this
work
one,
it
but
out.
We'll work it out. We'll go and get the facts and we'll have a discussion around it. Maybe that's what we can do over this Chrissy summer period is do a bit of a deep dive into some of these markets. So our objective is to help you make more informed investment decisions. And obviously investing is all about capital growth over time, but holding your properties for as effectively as possible, pre-tax, not post-tax, because it is a game of finance and it is a game of cash flow. So thanks again, Steve, Right Property Group. You hear more from him over the Christmas summer break. Remember to check out smartpropertyinvestment.com.au, and all these numbers that we've been able to share with you today, they're all on smartpropertyinvestment.com.au. Just click on the best suburbs page, but you'll see that you can put in any suburb you want and generate all this information. There's a whole bunch of demographic information there as well, census-based data that gives you the makeup of every single suburb, its economic diversity, the type of properties that live within it. So it's a really, really good resource. Go and check it out, smartpropertyinvestment.com.au. Remember to check us out, social media, if that's how you like to get your info, just search Smart Property HQ. Please keep that feedback coming. We're going to do some Q&A sessions over the summer period as well. Send your questions in. We'll get them answered, and we really enjoy doing those podcasts. Bit of a long podcast this time around. Hope you enjoy. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.